Good morning. It's Saturday, July 25th, 10:15 a.m. Maui time. You can see the islands in back of me. Let's see, there's Maui, Lanai, Lanai is how they pronounce it in Hawaiian, Molokai. But this is my uh, From the Balcony series, except today it's from the sun deck of the villa we have here. That's the people next to us in their villa. But it's beautiful. And being here has me in a reflective place, thinking about the markets. One of the things I was thinking about this Saturday, I'm going to sit down at the table here, is that the Fed's not going to raise rates. You know, I've been throughout my years writing. I've started writing publicly in 2013. Made a name for myself with the energy markets, in particularly natural gas, Antero, Range Resources, Expand Energy, EQT. Well, we had Equitrans and EQT, and other names too. I was in Oxy before Buffett was. I wrote a piece on ExxonMobil when it was exiled from the S&P, uh, actually the Dow, and said that it had that kind of emphasized the structural problems, and that was with the nameplate indices. And then ever since Salesforce replaced Exxon in the Dow, Exxon has outperformed in a spectacular fashion. So there's nobody that has actually shouldn't use superlatives. There's very few that have studied the energy markets like I have the last 15 or 16 years, including doing an annual update of E&P companies. And we've been in the golden age of active investing since 2020. Energy has really outperformed since that standpoint. There's cyclical bull and bear markets within secular trends, and that's true for the energy markets. We've been in a secular bull in energy since 2020. We've had these cyclical bulls and cyclical bears. With interest rates, we were in a 40-year secular bond bull market that ended in 2020. The last 5 or 6 years have been we're in the secular bond bear market, but there's going to be cyclical swings. So there's going to be cyclical bulls and cyclical bears in the secular bear bond market. And we're due for a cyclical bull market in bonds. And I am very confident the Fed is not going to raise rates, and here's why. The energy component of CPI is roughly, I was doing some research this morning, it's 6.3% of CPI. Of that, 3.2% is things like gasoline, diesel, propane, and 3.1% is residential electricity. So right now, the 10-year yield is correlated 1-to-1 with energy prices. And you've seen yields, we're not quite to the prior peak in May, but they've moved up as oil prices have moved up here. But that doesn't correlate in the long run. So yields, you'll see that 1-to-1 correlation will dissipate. And more importantly, and we saw this with the recent CPI report, but the housing shelter component of CPI is roughly 40%, maybe up to 44%, depending on how you calculate it. 26% is roughly its owner's equivalent rent. So that's if you own houses that homeowners and they were forced to rent those. Another 8% or so is rent of primary residence for those that actually do rent their homes. And then you've got another 4% or so from lodging away from homes. And what's happening is that component, so 40% of CPI, roughly, maybe even up to 44, 45%, is in a downtrend. So no matter what happens with the energy market, which is only 6.3% of CPI, and remember, about half of that is really only um, the commodity prices everybody's focused on. The CPI will be overwhelmed by that much bigger component of the housing and shelter. So we saw that in the last CPI report in July for June. CPI seasonally adjusted fell 0.4% in June, and that was much below expectations, down to 3.5%. And even the core CPI, which was estimated at 0.2%, came in flat. So the core CPI was 2.6%, unchanged over the last 12 months. August 12th is the next report. The market is now pricing in the Fed to raise rates, not only 1/4 point hike, but they're pricing in more than that. I just don't think that's going to happen. I don't think Warsh, his intention is not to react to short term market movements. And he's not one that wants to be known that way. He wants to stay behind the scenes. That's what he's advocated here. And he wants to shrink the balance sheet, which I think will actually allow them to lower rates. So if you think of where the opportunities in the market are today from that standpoint, if rates go lower, a lot of the stocks have been beat up a lot. The mortgage stocks, cyclical companies, they're going to have a tailwind, and it won't even take rates going lower. It won't even take Fed fund rates cuts. All it's going to take is the Fed for the market to price in or price out the prospect of Fed fund rate hikes. So I think that's a big opportunity right now because a lot of yield-oriented stocks have been beat up. A lot of economic sensitive stocks are, I think, lower than they should be. Lost in the market because the market's still pretty close to its highs. Is that a lot of stocks are way down from where they were in 2021, 2022, early 2022 at their highs. And as the tech trade, I'm just looking. I get mesmerized in the uh, the window because I see I'm looking at the window of our villa, and I just see the ocean and people walking by in the background. It's distracting, but in the best way possible. Back to the topic at hand. As money comes out, and you're starting to see it now because the tech trade is really under some pressure, and you're seeing semiconductor stocks break down. Some of the leading, memory stocks, optical companies break down. They're going to get bounces, just like we saw. Remember in March of 2000 when tech broke, the market saw tremendous volatility, just like we've seen the last 31, 32 trading days. Not only intraday, but session to session and multi-session volatility. But within that, there was a tremendous rotation. We are on fertile ground for that to happen again because the economy is much stronger than it was even in 2000. And remember, we only barely had 2 quarters of nominal negative GDP growth for a technical recession in 2001, but it was just by the slightest of margins. And that was a very mild recession with the NASDAQ down 78% from peak in 2000 to bottom in 2002. This time the economy's stronger. There's many more stocks that haven't participated that could have a good run here. And as the interest rate expectations change, I think that will become a story the next 3, 5, 7, 10 years. So I wish you guys could be here and just see the backdrop that I'm seeing. Every place I go, we went to Kauai, then the Big Island, now we're in Maui. I don't want to go. My creative juices are flowing. I feel like writing. I feel like recording podcasts. I'm thinking a lot. Just being by the ocean, there's something I always tell the guys that are on the Gulf Coast. You know, we've had places down there since 2020, but just being by the water, there's something about it that is spiritual, grounding, gravitational. I feel closer to God, in my opinion. I saw Taylor Sheridan talk about it on a podcast, and he mentioned that being close to the water, there's some effect it has on you. I really believe walking on the beach, grounding in the sand helps that too, but just being near the water does something to you. So I don't want to go. We're going to be in Maui for a few more days in Oahu, and we're going back to Kauai, but we can't continue indefinitely because the kids are all going back to school. We're already losing members of our party, as people have obligations, and I don't know if I could ever live out here, but being by the beach, being by the ocean is just wonderful. So far away from things, but that's an advantage. You know, it's a double edged sword. Your strengths are your weaknesses. I love the mountains, you know, of Hawaii. It reminds me on the different islands of like sometimes being in Tennessee or being in. I mean, some of the mountains on the Big Island were 13,000, almost 14,000 feet. But I love the ocean, and my body's sore. I've been surfing. It's hard to keep up, you know, now, but it it's really good for you too. So feel rejuvenated, and I think that